Good afternoon and good morning to those joining from other time zones. Welcome to Space42 first quarter 2026 earnings call. My name is Brujidara Stoyanova and I'm leading our investor relations function on an interim basis. It's a pleasure to host today's call. With me are Karim Michel Saba, Managing Director of Space42, who will walk you through our strategic progress during the quarter, and Andrew Ko, our Chief Financial Officer, who will then take you through the financials. A few brief housekeeping points before we begin. All participants will remain in listen-only mode throughout the presentation, with a dedicated Q&A session to follow. Questions may be submitted through the Q&A feature at any time. Please include your name and organization, and I'll read them through during our Q&A. You may also raise your hand, and I'll bring you in and ask your question directly. Today's discussion contains forward-looking statements, and our standard safe harbor language applies. The full release and supporting materials are available on space42.ai, and a replay of today's webcast will be posted to the investor relations section of our website shortly after the call. With that, I will hand over to Karim.
Thank you, Boji, and welcome everyone. Thanks for joining. As I stated in the official communication this morning, Space42 maintained a positive trajectory with another quarter of first year-on-year revenue growth, second, rigorous cost discipline, and thirdly, and importantly, a relentless focus on our strategic execution. The business delivered a strong financial performance during a period of regional unrest, reflecting the resilience of our operating model and the firm foundations we have laid. The strong performance also underscored the relevance of our dual-use remit, i.e. serving the commercial market as well as the government market, with a focus on particularly the government applications which proved to be essential for our end users during the recent conflict. Finally, in terms of my introduction, Space Services delivered its highest ever Q1 revenue, while Smart Solution continued its strategic transformation towards programmatic engagement with a 2026 target of return to growth through a higher value set of engagement aligned with our core capability. And it is something that we have emphasized during the course of our earlier conversations. Moving on to page 7, Boji. In Q1, we have set the stage for Space42 to fire across its 4 core pillars. When it comes to preferred partner for premium geospatial data, i.e. being able to leverage our assets in space and from there to deliver sovereign capabilities to our end users, we're in the process of securing a pipeline of new contracts with start of service in Q2. Moving on to our second pillar, in reference to becoming the global leader in geospatial intelligence, leveraging our AI capabilities and delivering essential services. Our GIQ platform and its government equivalent, our GIX platform, have entered active production with a focus on sovereign demand starting in Q2, which is way ahead of schedule. And again, recent events have emphasized the relevance of our capabilities. When it comes to our target global non-terrestrial network leadership target with Equitas, our joint venture in progress with Viasat is expected to achieve important milestones in Q2 with related communications to follow in the coming weeks. And lastly, when it comes to our positioning as a trusted leader in secure communication, where our Alia 4 and our legacy Alia solutions have performed superbly in Q1, particularly in the context of regional events, again, underscoring the importance of this sovereign capability and certainly paving the way for our upcoming program starting with Alia 4 and Alia 5. I would like to spend a bit more time on each one of those pillars. So, Boji, I'm going to ask you to go back to page number 8. Under pillar number 1, we have progressed well the operational readiness of Foresight 3, 4, and 5, meaning that we'll put them into productions, i.e. start delivering services through these assets starting in Q2 with commensurate data acquisition mandates from our end users, and 2 mandates are in fact under negotiations as we speak to start delivering the services in Q2. Moving on to the next page, Q1 was a watershed quarter for GIQ and GIX, our geospatial intelligence platforms. As I've stated earlier, recent event, in fact, underscored the essentialness of situational awareness through geospatial capabilities and the importance of rapid analysis and interpretations using AI tools for our government users. And as a result, GIQ and GIX were put into intensive production to address critical questions for our end users. and we received high marks for our work, paving the way for an acceleration in Q2 of delivering these services. Moving on to our third pillar, Space42 performed superbly on its core mobile satellite services through Thuraya 4, our latest SATCOM spacecraft. We delivered against our multi-year service mandate with the UAE government, supplying secure and resilient communication at a critical time. And we experienced a marked pickup in our commercial demand, which will also flow into Q2. We also made considerable progress on Equitas and expect to communicate significant updates on our execution with Viasat in the weeks to come. Our goal is to launch satellites manufacturing in 2026, enter operation in 2028 and 2029 window. Now, as a reminder, the opportunity before us is the direct-to-device market, which yearly value could exceed $50 billion in terms of revenue. Now, moving on to our fourth core pillar, our secure and sovereign communication SATCOM services proved to be essential for our government users during recent events, and we have achieved high marks by securing continuity of services under demanding conditions during the weeks that we've all experienced. We've also stayed the course on Aliyah 4 and Aliyah 5 in terms of program development, and I'm glad to report that these programs, again, notwithstanding recent events, remain on time, on spec, and on budget. As a reminder, the Aliyah 4 launch is planned for 2027, Aliyah 5 is planned for 2028. So these are within the horizon of our medium-term planning. Now, in parallel, we're actively working on securing a complementary non-geostationary capability that will integrate our secure geo-based or geostationary-based secure communication network, something that we talked about during the Investor Day and remains an active priorities. Last but not least, on the thematic front, our autonomous mobility work continues with the activation of our joint venture with A2Z, bringing to bear also our mapping and geospatial capability. And the initial rollout of the new capability has already started in Abu Dhabi. Now, the point I want to emphasize that we're in the process of translating this capability, i.e. autonomous mobility, which we are combining to our other sovereign capabilities to deliver a holistic solution to serve the government segment in the domain of defense and security with a new programmatic engagement expected in H2 2026. Finally, I will conclude by reiterating the following. Q1 is providing the setup for a constructive 2026 and in full alignment with our strategic principles of programmatic growth, capability differentiation, scalability, and financial discipline. Andrew, over to you.
Thank you very much. Thank you, Karim. Good morning, good afternoon, everybody. Thank you for attending our Q1 earnings call. So I will give you an overview of the financial performance of the business. And the first quarter for 2026 was for Space42 a robust and a strong first quarter. And we continued very much in the same way that we left 2025. You might recall in 25, in Q4, we recorded a revenue growth of 7% versus the comparative quarter in 2024. And we were able to maintain that top line momentum in Q1 this year, underpinned by, as Karim alluded to, a record-breaking performance in the space services business, which saw its revenue surge by 15% year on year. And that actually marks the fourth consecutive quarter of the space services revenue expansion. Now, at the same time, the smart solutions business advanced its strategic transition to programmatic engagements. This transition is not yet complete, but we expect it to complete in H2 this year. From that point on, we then expect a rebound and a revenue profile, which is growing in that business as well. We also maintain strong control of the cost base. And we'll come onto the entire cost base, compare it to the prior year, you'll see that it is stable. And what that means is that our normalized EBITDA was in line with the prior year with a comparable margin, which was certainly strong and stronger than the margin that we had for the full year last year. So overall, a robust Q1 performance, whilst at the same time we maintained a very strong balance sheet For those of you who've reviewed the financials, you will see that we closed the period with over $1 billion in cash, a negative leverage of minus 3.5 times, and a net debt negative of minus 0.8 billion, and at the same time, a backlog of $6.4 billion. So it's a very strong start to 26, a stellar performance in space services, good progress in advancing the transition in smart solutions, and a rock solid balance sheet. Now, if we move to the next slide, Boji, we can look at the income statement in a little bit more detail. The revenue profile you see is up versus the prior year, and there's a dedicated slide on that in a minute, which I will come on to. The next three lines, cost of revenue, staff costs, and other OPEX. This is the cost base for the group as a whole, which was stable year on year. You can see a notable reduction there in staff costs. The headcount was down 2%. Now, the prior year did have a one-off benefit in other income, not to be repeated in the current year, which related to insurance proceeds, which were derived from an anomaly of the Alio 3 satellite, which happened more than 2 years ago. And so for that reason, because of that one-off item, the EBITDA year on year was down. But on a normalized basis, when you strip out the one-off items, and we have a slide on that which we'll come on to, you'll see that the EBITDA was stable with a comparable margin. Now, below EBITDA, we have a few other items. Depreciation was higher than the prior year, which you would expect because the new T4 satellite and ground segment is now in use. It came into use at the beginning of H2 last year. And the net finance income, and it was income, which is obviously a positive, but it was a bit lower than the prior year, reflecting the fact that in the prior year we were able to capitalize finance costs relating to the T4 satellite. We're unable to do that now from an accounting perspective because the satellite is now operational. So for that reason, the net profit is lower than the prior year. We do expect that to rebound, though, by the end of 2026 with a full year growth expected. Go to the next page, we then see the normalized results. And so for those of you who are not familiar with this, we adjust for one-off items which would otherwise distort the like-for-like comparisons between both periods. So you can see in Q1 this year, there are no one-off items to adjust for, but in the prior year, there were a couple. There were restructuring costs which were incurred, and then, as I said earlier, the one-off insurance proceeds. So when you back those out, you can see that actually like-for-like, the EBITDA pretty much in line with the prior year. The net profit is a bit lower, reflecting the higher depreciation and lower net finance income. But as I said, I expect that to reverse and to grow for the full year as the smart solutions transition completes and it starts to ramp up its revenue profile. Now we can move on to the revenue profile on the next page. You see overall there was an increase, albeit a modest increase year on year, with all of that increase coming from the space services business, which grew its revenues by 15%. This is off the back of Q3 last year, where you had double-digit revenue growth in space services. Q4, you had double-digit revenue growth, and we would expect, again, double-digit revenue growth in space services in Q2. And this is really underpinned by the new government contract relating to the recently launched satellite Thuraya 4. And for those of you who don't know, it's a $700 million 15-year contract yielding approximately $50 million of incremental revenue every year, and it started on the 1st of July last year. The smart solutions revenue profile you can see is lower. This did not come to us as a surprise. This reflects the fact that this business remains in transition. We're moving it from a business that previously provided relatively ad hoc projects to one now programmatic engagements geared towards Earth observation and geospatial analytics. And as we get the right assets and capabilities in place, and as alluded to by Kareem, the Foresight constellations, 3 of these satellites have just completed the in-orbit testing. Those will start to enter commercial service this quarter. Then we expect that revenue profile to rebound and to see a return to growth in that segment. The following page reflects the normalized EBITDA, which broadly in line here, 54 million versus 53. Again, it's a slightly similar story to the revenue profile in that the The space services normalized EBITDA leapt by double digits, up 10%, whereas the smart solutions declined and was down versus the prior year. Again, as that business transitions and the revenue profile begins to ramp up in the second half of the year, then we can expect to see a rebound in the EBITDA performance of that business. The next page then gives you the rollout of the backlog. And this is essentially future revenue that is already secure as of today. It's just a question of execution. It's a total of $6.4 billion equivalent to about 11 times our annual revenue, comprising about 3 or 4 major government contracts within the space services business. And what this slide does, it shows you how that backlog rolls out. It runs all the way out to 2043, in case anyone's wondering, with the first 385 million expected to crystallize in the 9 months remaining of this year. And of course, this backlog provides huge visibility and security over future cash flow. And it should be noted that the end customer with whom we're contracting here is largely the UAE government. The following page then gives you the cash bridge, reconciling the starting cash position as at the end of last year to the closing as at the end of Q1. And you can see the balance is up. It's up 3%. The cash flow from operating activities was very strong across both businesses, actually reflecting strong levels of cash collection, which more than offset the capex that was invested on the group's key programs, principally Alia 4 and Alia 5. And finally, the last page shows you the balance sheet, which remains very strong and very stable. In fact, if you look down the Q1 position versus the prior year position, I mean, there's very little in the way of movement. The fixed assets, the capital work in progress are all quite stable. And there's a lot of moving parts there, but the overall position is one of stability. The cash, as I just said, is up slightly. The contract assets is down quite significantly, and that's a positive because it's reflecting the fact that we are converting working capital here into cash. And the borrowings you can see are stable, although I expect those to fall by about 60 million by the end of Q2. So overall, it's a very good set of results, strong start to the year, positive top-line performance, rigorous control of the cost base, robust margins, a stellar space services performance, good progress in the transition of smart solutions, as we expected, and a very, very solid balance sheet and a positive outlook for Q2 and for the rest of the year. And with that, I will hand back to you, Boji.
Karim and Andrew, thank you. We'll now move into Q&A. We have already one question from Rahul Singh submitted in our Q&A. This one is for Andrew. What new contract pipeline does management expect to add across the lease and managed services businesses within the space services segment, and what CAGR growth trajectory is targeted over the near term? Additionally, what annual revenue contribution is expected from the Alia 4 and 5 contract for the forecasted period? And how does management expect the revenue mix between lease and managed services to evolve going forward?
Okay, for the Alia 4 and 5 contract, it's a 17-year contract which commences in November this year, worth $5.1 billion with annualized revenues of $300 million. So the primary contract is Alia 4 and 5. We also are working to establish, and we have plans to establish, a multi-orbit strategy, LEO broadband as well, and that will add to the revenue profile in space services. In terms of CAGR, we don't necessarily give guidance here, but I can tell you, combined with the direct device initiative, which we can talk about, we are looking at a double-digit revenue CAGR between now and the end of the decade. And we've already announced in our Investor Day that we have an ambition to double our revenues by the end of the decade.
There is another question from Rahul. Is the CapEx expected to remain intact at FY 2026, 324 million, FY 2027, 298 million, 28, 270 million, and FY 2029, 131 million? As above, provided in the Q3 25 investor presentation of USD 1.3 billion over 5 years, how is the expected CapEx to be funded?
Okay. So we have a CapEx projection of $1.7 billion over the 5 years, which is what we presented at the Investor Day. There will invariably be shifts in that capex. I seem to recall in the first year of that 2026, we projected 800 million of capex. I can quite conceivably see some of that capex shifting to 2027, but the overall envelope will remain the same. In terms of funding, as you can already see, we have more than adequate funding on our balance sheet. We also expect to receive another advance payment from our end customer of 200 million by the end of this year. We also have an undrawn ECA facility of 700 million, which we announced last year. We expect to do the first drawdown of that shortly. So there is more than enough liquidity to fund this investment program.
Okay, we'll now take questions from those who have raised their hand. Please do introduce yourself and name and organization before your question. Scott Darling, I just unmuted you. Please go ahead and.
Good afternoon, everyone. Good afternoon, everyone. It's Scott Darling from Cantor Fitzgerald here, and congratulations on the great momentum in the business and also the detailed presentation. I've got 3 questions. Firstly, you mentioned smart solutions in the ongoing transformation. I mean, what is your views on sort of revenue momentum, sort of quarter on quarter? I mean, could 1Q sort of be the low point for 2026? That's the first question. And then secondly, you mentioned a lot of pipeline for new government and commercial contracts. Are you able to give a little bit more details around that? Because we do get also a lot of questions around the defence sector, especially with the regional conflict. So any comments around that would be good. And then my third question is, it seems good progress on Equitas. We look forward to seeing what you announce soon and hopefully some guidance around that. But if I listen correctly, you're saying D2D is around $50 billion in revenue. I mean, even if you were to take, just say, for sake of argument, 2% market share of that, I mean, that's at least $1 billion revenue type business. What's your comments on that? Thank you.
Okay. So on the first question for smart solution, yes, it is Q1 is a starting point. So thanks for the question, Scott. And from that point onward, we expect, and our plan is to deliver quarter on quarter growth, i.e. every quarter from this point onward would be an improvement on Q1, which effectively means that smart solution will end up significantly higher in 2026 versus 2025. Now, there may be shifts further to the rights, depending on the timeliness of firming up some of the new contracts we're working on, which is a good segue to the second question. And probably I can provide you with some colors along the 4 pillars that define our strategy. On the first pillar, which deals with delivering through our sovereign capabilities and the capabilities of our partners such as ISI, data for situational awareness for our government users. We have 2 contracts under negotiations as we speak. Recent events have accelerated the essentialness and the timeliness of these services, and in fact have put emphasis on delivering these services at a higher cadence and in higher volumes. And you may appreciate that situational awareness is front and center to decision making for policymakers. So that's an example of some of the contracts that are in negotiations as we speak. Moving on to the second pillar, I've referred in my brief introduction to the acceleration of the deployment of GIQ, which is our geospatial intelligence platform, specifically for government use cases. And recent events have created the conditions for a faster deployment of these capabilities, and it's entering into production, which effectively will translate at a faster rate into revenues over the course of 2026. And again, this is not a one-off project. This is a platform that is meant to create a foundation for sustained revenue generation over the years to come, and also an expectation from our end to continue to invest in the development of this platform. And bear in mind that this platform is comprised of, A, the ability to tap into a vast repertoire or inventory of data generated from sensors in space and on Earth, the ability to aggregate this data in a coherent manner to address the use cases specific to our end users, in this case, government applications. Thirdly, to run the analysis to derive the so what, and in some cases, not in all of them, to draw inferences. But most of the heavy lifting of our platform is around the third bucket, which is run the analysis and derive the so what in terms of situational awareness, along with the analysis of what does this mean to inform decision making. When it comes to our secure communication, which is our fourth pillar, the business is delivering against long-standing engagement. We do not expect at this stage to secure additional new engagement when it comes to this part of the infrastructure business. There's a growing interest now to develop adjacent to these SATCOM capabilities, infrastructure complementary capabilities, as well as managed services. And in fact, our CEO for Space Services, Ali Hashmi, is with us on this call. And he has been spearheading an effort to develop some of these capabilities, particularly at the level of the terminals in the UAE, which effectively means that through our vertical integrations, we are able now to deliver a sort of a more holistic solution of our end user and a solution that is truly sovereign end-to-end. And that, again, paves the way for additional engagement, which sort of, and by design, I kept the third pillar, which is non-terrestrial and mobile satellite services, towards the end, because it sort of dovetails with your equities question. So the opportunity before us is indeed massive. And the number that I've sort of mentioned on this call, you can sort of develop it top down from similar sources. If you work on the premise that the total mobile market today, excluding markets that are sanctioned market, i.e. where we cannot and we will not deploy our services, that leads you to an annual revenue top line of around $1 trillion. And if you work on the premise that direct-to-device can prosecute 5% of this market, because 5% of end users will require that there is a continuity of their mobility experience in non-covered territories, whether it's land, air, or sea, which is not an unreasonable assumption, then the 50 billion number is within reach. And yes, while I do not want to put a market share for equities to against this 50 billion, we have a massive opportunity before us as an industry, and specifically as equities and Space42. And so we're quite ambitious about this program, which is why we're working around the clock to get out of the starting gate in terms of satellite manufacturing, because that is sort of the next milestone before us. And I don't want to run ahead of my skis on this one. All I'm going to say is we're actively working on that with our partner Viasat, and we look forward to the upcoming announcements in the coming weeks.
Excellent, thank you.
Thank you.
We have a question from Dominic. Dominic, please go ahead and ask your question.
Yeah, this is Dominic with Consilium Investment Management. So my question is just on the smart solutions segment. How should we think about monetization there in terms of growth going forward? You know, is it going to come mostly from the GIQ platform, and how is that platform going to be monetized? Is it on a recurring revenue basis? Is it on a contract basis? And are there other kind of levers that you're going to pull to drive growth in that segment? Thank you.
Thank you for the question, Dominic. And it sort of joins a bit the question from Scott. So this is an opportunity for me to expand on it. The monetization of smart solution is along the following levels. First, in terms of data acquisition, because there's an increased requirement to deliver data with a first set of analysis to our end user. And so that is a very significant revenue stream. And we're in final sort of negotiations, crossing the T's and dotting the I's on 2 such contracts, which are service-based. And on the one hand, you are delivering the raw data. On the other hand, you're running the analysis around this data to provide a first layer of interpretation around. As I stated earlier, the baseline pre the recent event was a certain volume and a certain cadence and a certain level of revisit, and that baseline now has moved up. because of the environment in which we operate. And therefore, that equates to an increased demand for such services. So it will be a recurring demand, and it's service-based. GIQ and GIX have a revenue model that is premised on two levers. The first one is the setup of the platform or the access of the platform depending on the requirement of the end user. In some cases, it's accessed as a service. In other cases, it is deployed on premises for different reasons. And so that you have a first sort of layer of revenue coming from this deployment. The other level of deployment, as you rightly noted, it becomes one of a recurring service on the basis of the models you have developed for the known use cases. At the same time, there is a monetization when there are new cases that are presented or required, and therefore there's further development on the platform to be done. And once the model is ready, i.e. that the underlying AI model is ready, then there is a recurring revenue stream that would follow it. Finally, the other revenue stream for Smart Solution is from the deployment of our autonomous capabilities or our autonomous mobility capabilities. And so this is part of the legacy work that the previous company, Bayanat, used to deliver. We have upgraded now our capability through the joint venture with A2Z. There's an initial deployment that we have started now based on this new platform, which allows us to serve the market in two ways. One, to retrofit existing vehicles, so legacy combustion engine vehicles, while at the same time being able to deliver brand new vehicles. And the first capability is quite unique in the market because it allows you now to penetrate an inventory or a repertoire of vehicles that are already on the ground or a fleet and upgrade that fleet to a level 4 type of autonomy, which is quite relevant to end users for economic reason, for productivity or efficiency reasons. Now, what we're also doing, and the last thing I want to sort of conclude on it, is we're combining the first two capabilities I referred to under our data acquisition, as well as GIQ, GIX, as well as our autonomous capability to now develop a platform which we refer to as an autonomous platform for defense and security. There is a massive effort underway to frame this program with our end user, the UAE government. And we expect this program to be out of the starting gate during the second half of this year. And that program will follow a monetization model, which again is an initial setup and then a service-based monetization. I hope this answered your question.
Yes, thank you. Very clear. And just if I may quickly, if we look on a long-term time horizon, what's the expectation for the split between Smart Solutions and Space Services? Are you expecting to be 50-50 eventually, or is there some target range?
Yeah, so I think we referred to this in our Investor Day. And of course, 2025, the split was 78%, 22% in favor of Space Services. But going forward, we do expect the Smart Solutions business to grow at a faster rate, albeit from a lower base than Space, and be an approximate range of 70% Space and 30% remain broadly stable over the next few years.
Great, thank you.
We have another question from James Retzer. Please go ahead, James.
Yes, great. Hi, so thanks for taking the question. It's James Retzer from New Street Research. I was interested to kind of discuss strategically the kind of relationship both between you and MNOs directly as you roll out direct-to-cell services, and then the relationship between Equitis and those MNOs. And the reason I ask about that is because you might have seen about an hour before this call began, but in the US, Verizon, AT&T, and T-Mobile have just partnered together to pool their own terrestrial spectrum for offering to satellite constellations. So I suppose a few questions from this. I mean, one, do you see that as an opportunity for Equitis in the US market? But then in the markets directly where you actually have L-band spectrum rights, Are you finding in your discussions with MNOs they would rather use their own terrestrial spectrum for D2D services on Equitas, or would they rather kind of come to you and also use your own spectrum rights for this service? Thank you.
So from our conversation with MNOs in Africa, Europe, and Asia, the inclination is for MNOs to favor the scenario where we bring the spectrum into the direct-to-device solution, i.e. leveraging our L-band spectrum. That is the most efficient way for them to bring the service to their respective markets, and also in the most cost-efficient way. There have been also interest, to your point, from some MNOs to propose that we also accommodate on Equitas their own terrestrial spectrum, and the Equitas model is designed to be able to sort of onboard such a capability in the future, i.e. the payload that we are designing will be able to deliver against such an opportunity. So to follow the SCS model that was introduced in the United States. So the answer is the entry point with all the MNOs that we have been in conversation with Equitas as sort of the tower company in space, and also as Space42, the service provider, i.e. us acquiring the space resource units from Equitas, and then sort of slicing and dicing these space resource unit into different service offerings that the MNOs can now take to market in their national geographies is the nominal model. But we're also certainly entertaining the complementary model that will come on top. I can't comment, I mean, the news is fresh. It makes sense for a coherent approach from MNOs in a scenario where they want to also bring to bear their own spectrum into the direct-to-device. But I think we should let dust settle down on this announcement before we opine any further on it. I'll conclude by saying the main value proposition of Equitas is being able to bring to bear to MNOs around the world a single globally harmonized spectrum, because it's the most cost-efficient way to deliver the service in a sort of on the shortest critical path first, but also at a unit economics that will be truly disruptive versus the legacy MSS services, and then will allow us to penetrate the market potential that I've underscored in my introduction, and I've sort of repeated when Dominique and Scott raised the question about the market size of Equitas.
That's very interesting. Yeah, thank you for that answer.
Thank you.
We have one last question, which was posted on the Q&A feature. So there are actually two questions. Considering the recent market scenario, have you seen the rise in chipsets and other raw material costs? And going ahead, how will this pass on the existing new contract?
Now, maybe I can simplify the question, and please bear with me. Is there an impact on our programs based on what we've seen as potential or actual price increases in some of the subcomponents or subsystems? And the answer, it is possible. Nevertheless, as I have stated, and my colleagues also have stated during the Investor Day, our number one objective is to be able to achieve the lowest space resource unit in terms of production in space, and therefore delivering the most cost-efficient service on the ground. And so, notwithstanding the fact that there are going to be cases where some of the components or the subsystems may experience price increases, through our increased vertical integration, one, and two, the system designs that we now are controlling with our partners. So whether it's at the level of SAR-based or radar-based spacecraft for Earth observation, so with our partner ISI, or in the case of direct-to-device with our partner Viasat, we are, and allow me to use the following word, we're absolutely obsessed on making sure that we continue to deliver the lowest possible space resource unit from a price standpoint. And so, again, I won't eliminate any scenario where these individual prices of components will increase, but no, A, we're not seeing an impact on the work we're doing, and two, I think this will create further incentive and motivation for us to keep on driving sort of the efficiency of our systems.
The second question is, can you highlight the reason of lower staff costs, and should we expect to similar in this quarter as well?
So I can answer that one. So the staff costs amount to almost a half of our cost base. So obviously, we pay a lot of attention to it. Now, the key reason for the reduction year on year is actually in the quarter 2025, first quarter, we had some restructuring costs, which were not repeated. So of the 3 million reduction, 2 million of it relates to that. That obviously leaves another million or so reduction, and that reflects the fact that our headcount is down 2% year on year. Do we expect to see a similar reduction in Q2? No, I would expect that the staff cost to remain stable. I would also add one final point around the synergies. If you compare the projected staff costs pre-merger of both companies aggregated to the combined staff costs of Space42 now, you'll see a very significant reduction, annualized of about 20 to 30 million a year.
Okay, this was the last question. Thank you all for your time today. Q1 marks another quarter of disciplined execution and strategic progress for Space42. And we appreciate your continued engagement with the company. For any follow-up, our investor relation team is reachable at ir@space42.ai, and additional materials can be found on our website. We look forward to speaking with you again at our half-year results. Have a good rest.